Bill is a straight shooter. And we call it, well, he's called Mr. Gold. I mean, I don't know anyone else other than Jim Sinclair that was called Mr. Gold. So thank you for joining us today, Bill. And I know that we really always welcome your straight shooting, Texas style talk.
Thanks for having me, Andrew.
Well, I guess really, you know, I think there's one thing I have to start with, Bill, and this was the one thing I have to start with is you were, and I remember, I think 2 years ago, 3 years ago, it was a long time ago. One of the things you said, which was right out there as far as most people are concerned, because when you were talking about silver was trading in the teens, you know what I mean? It's like, you know, why would anyone be interested in any kind of issue with silver? And you said silver is going to be the one asset class that brings the entire financial multi-quadrillion derivative system into implosion. Bill, I'm looking at it. This was like years ahead. What are we looking at here?
Well, we're looking at ultimately a failure to deliver, and a failure to deliver. I mean, I've said for years now that silver was the fuse that would blow up the gold's derivative bomb, if you will, and that immediately spills over to credit markets. It must be understood that the reason gold and the reason silver have been suppressed since 1975, since they started futures contracts on the metals, the reason for the suppression is to allow, or was to allow, the financial world, the media, to point at gold and say, see, gold bad, dollar good. And a low gold price allowed the U.S. government basically to borrow unlimited amounts of capital. I mean, had gold been left to its own and traded to at levels, multiples probably of where it is right now, that scares money away from U.S. credit. So it was a way, suppressing gold and silver was a way to support, if you will, the dollar, and also, most importantly, the ability of the U.S. Treasury to borrow. Once you see a failure to deliver in silver, within 72 hours, it's pretty much game over, because the entire derivatives edifice is going to crumble, because credit/derivatives are based on trust, based on confidence. And if you fail to deliver on a contract, it displays to the world that contract was a fraud. And if you've got fraudulent contracts out there, you're going to have capital fleeing, looking for a safe place. And that safe place just happens to be gold and silver that they've suppressed for so many years, because they can't bankrupt, they cannot default in a world that is in the process of defaulting.
Well, back in December, you said, watch out in March, you know, talking about current levels of inventory, but and the imbalances, which we know are there, but essentially nothing's different here. When you look at the big picture, it's exactly what you said in December, and it's just continuing to play out. What did you say of what would happen in March?
Well, I said watch out for the March delivery month, simply because the game has changed. It used to be that, and I'll just use the number 100. It used to be 100 contracts would stand for delivery on first notice day, and by the time it came to deliver, there might only be 6 or 7 or 3 or 12 contracts that actually stand for deliver. They all got basically paid in fiat to walk away and not take the metal. Now, over the last year and a half to 2 years, that has changed. The number that you see on first notice day, that number now grows during the month. So whatever stands initially stays, and then you've got new contract buyers that step up, buy the contract, and they stand for delivery. So you saw, I think the number was 30 million ounces in January. I think we're about 25 million ounces here in February. And this is versus basically 100 million ounce registered inventory that's available to deliver. And as of right now, there's a shade over 200 million ounces represented by the contracts that are open in March versus 100 million ounce delivery. Now, if first notice day, we come in at 80, 90, 100 million ounces, I'm going to say that's game over, because by the end of the month, it's going to be way more than 100 million ounces. And where's the silver going to come from to deliver?
Yeah, and especially as now we're running into, I think what's really causing the COMEX the issues, and I know we've been looking at this for a lifetime. Essentially, what they used to be able to do, as you say, is that they would take the short side, collude, and then know where everyone's margin position was, and literally make it very unattractive to complete that purchase by literally taking it down beyond a certain percentage, where you think, maybe it's going to go down further. I'll cash settle and buy later. It's all changed. It's all changed because they don't set the price anymore. It's being set in physical exchanges in Shanghai and Western-facing free trade zone or gold and silver corridors that are 100% backed by physical. So these guys must love it when the COMEX starts discounting gold and silver, especially silver, because you can't, while you can EFP a gold position and where it lands at a fix, just the 3 to 5 times that lands at a fix is a first tier asset, has to be Basel III compliant. The other 800 tons that trade that day doesn't have to be. So, but silver, the incentive to actually go to the back door, not EFP it, because the minute you EFP silver into London, it becomes an unallocated position, which you then have to negotiate a higher price for. So that means you have to literally load it out the back door of the COMEX. So you can't just shove it across the blue center line and call it delivered like they used to. It's leaving. It's actually leaving. So Bill, what the heck happens here when the door rolls open and there's just a few bars there?
Yeah, I mean, you're describing the process that leads up to the failure to deliver. What's happening is, if you go back 5 years, 10 plus years, it used to be that the pricing of gold, the pricing of silver was strictly done in collusion between LBMA and the CME, New York and London. But what's happening now is the demand for silver, because it has so many different uses, the tail, meaning the derivatives market, is no longer wagging the dog. The dog is standing up on its own and it's starting to wag the tail. In other words, the cash markets are pricing silver, they're pricing gold, and the futures contracts in New York and London be damned. And that's proven. Just look at the price in Shanghai. Look at the price in Shanghai. Look at the price in India. They're both at a premium right now. Shanghai's $11 higher. In what world could that exist without arbitrage? And the reason the arbitrage is not closing that gap is because if you sell a contract or sell physical metal in Shanghai, now you're short, and you buy it in New York, and if you don't get delivered on, you're short. pure and simple. So the reason the arbitrage, that spread exists, is because, in my opinion, traders are afraid to go short in Shanghai because they don't know 100% positive that they're going to be delivered on in New York.
Yeah, and even more difficult when onshore. They're not. You're not exporting any silver. You've locked it down for military purposes, for AI purposes, for strategic purposes. So yeah. So even on the free trade zone side, where the Western banks can operate, it's just, as you say, it's pointless taking that. Who wants to take that risk when everyone, especially a well-connected person, knows that there's a shortfall?
Exactly.
Well, this is. I keep saying to people, we have to give our head a shakes here. This is history in the making, and we're privileged to witness the end of this 50 years you refer to of price suppression, where, as you've many times in the past educated people into saying, where did the COMEX come from in the first place? What was it designed to do? And I know if you could just explain to people one more time, why was the COMEX launched? Obviously, silver was trading in the 30s, but gold, after Nixon took gold off the peg. Tell us the story.
Yeah, back in the mid 70s, when they created the futures contracts, they were created, and actually, I just posted this on my site 2 days ago. Data had put out a press release back in 2017 where there was an intercepted cable that talked about the origination of the COMEX futures contracts, and that the purpose was to be able to control and suppress the price of gold and silver. It worked as a relief valve, if you will, on the pressure of physical buying of gold and of silver. Now, you can add one more group to one more layer on top of the suppression, and that was the ETFs, GLD, SLV. If you look at their prospectuses, they do not have to own physical gold. They do not have to own physical silver. They have to own, they can own physical metal, but they're also allowed to own contracts. And when this came out in 03, GLD, and then I think SLV came out a year later or 2 years later, right off the bat, I said, this is a pressure relief valve. It makes it easy for somebody to point and click in their brokerage account and purchase GLD, purchase SLV, and say to themselves, okay, now I'm hedged. I own gold, I own silver. The only problem is that's not true. You don't own gold, you don't own silver, you own contracts. You have a paper conduit to your ownership of the metal. So what it did was it steered what would have been physical buying, cash and carry, you buy it, you take delivery. It took some of the pressure off of that and diverted funds into the ETFs. Now there's one more layer, and not too many people have talked about this, but I fully believe this, that the cryptos themselves were also a pressure relief valve for investors who wanted to get out of fiat. What they did was they've offered another avenue to get out of fiat and into something. I guess when I say something, what is Bitcoin? What are cryptos? In my opinion, they're digital air, and when the rug gets pulled, those are going to be zeroed out. So in the end, you either own physical gold, physical silver, or you don't. If you own the ETFs, you don't own gold or silver. If you own crypto, like I said, I don't know what you own. In my opinion, it's digital air. But all three of those instances, were all used to suppress the price of gold and to suppress the price of silver. And oddly enough, gold and silver since January of 2000 have been the best asset class to own.